Hi everyone, and welcome to this episode of Money Moves. I make this video every 2 weeks, and I talk about at least one or two articles that I think are relevant to investors today. And for this week, I want to talk about how much real estate should you own in your portfolio and what technically counts as real estate. Then I will go over each of my investing platforms, starting with Worthy Bonds, GroundFloor, Yotta Bank, Fundrise, my retirement account, my M1 accounts, and I'll finish up my investments with my options portfolio with Robinhood and Tastyworks. I will finish up this episode with my bi-weekly tracker. And of course, there will be some jelly at the end, which is something I enjoy outside of the markets. If you have big dreams like owning this 4-bed, 6-bath mansion just outside of Savannah, Georgia, or if you're just getting started on your financial journey, definitely like and subscribe. It seems to have a good blend of modern and traditional styling, and one of these. But I don't know what's going on with this giant vertical tree. Honestly, you can see this thing from space. It's right here. Then it has a basketball court / tennis court, a huge bridge out to the closest river. It's currently on sale for $2.9 million. Welcome to the Portfolio Bulletin. Let's get started. So how much of your money should be in real estate? They say private real estate has been a hedge against the stock market for years due to its low correlation with stocks and bonds, rising and falling well behind the economy. I'm not sure why they're specifying private real estate. Any kind of real estate investing is going to act similarly to any other kind of real estate. And they mentioned the Yale University Endowment Fund, which has returned 12.1% over the last 20 years, has a large amount invested in private real estate. The fund currently sits at $27 billion, and 10% of that is in real estate, and reached as high as 20% in 2013. They did a survey of high net worth investors, representing around $51 billion in assets, and around 33% of that was invested in private real estate. Based on a study at Cass Business School in London, they say the optimal allocation is 26%, but actual allocations are much lower due to perceived risks and illiquidity. Now, this illiquidity issue is kind of annoying when it comes to private real estate. This is like buying a home and then having to go through the process of selling that home, which makes a home significantly more illiquid than, say, buying a public REIT or buying a stock. You can just sell it right away, and there's very minimal costs, if any, to getting out of that investment. Whereas buying a home costs a lot of money on top of the money you have to pay to own the asset, and then selling it costs you a lot of money as well. You also have to find a property that you like, and then you have to find a buyer to get out of the property, which all takes a significant amount of time and effort. So the way around this is to have investments like Fundrise or buy public REITs, which give you similar exposures with more liquidity. And of course, that liquidity generally costs you a little bit of returns, but it's much easier to get in and out of and significantly less capital intensive. The example that they give here is a family with around $300 million in net worth, and they may be fine with having up to 50% of their money in illiquid assets. But if you're a much lower net worth individual, then you may not want to have quite as much money tied up in illiquid assets. So how much is reasonable for the average person? They suggest no less than 10% and no more than 30% here, offering a middle ground of the 20% rule, which was part of the Yale model, as I mentioned, meaning that if you have $25,000 invested, around $5,000 of that should be invested in real estate. And just to put the final nail in the coffin here, the potential of alternative investments being a benefit to your portfolio. Low correlation to stocks and bonds offers true diversity, which is much different than just buying two different kinds of stocks, where they will generally move in the same direction, especially in a dramatically rising or falling market. They also mention that 30% of pension funds and over 50% of endowment funds invest in alternative assets, as opposed to the 5% of individual investors. Clearly, the little guy is not paying attention to the bigger trends, and investing in real estate as an alternative investment definitely is a good idea for diversification as well as potential returns. Of course, this does not fall into place with modern portfolio theory, which currently suggests 80% stocks and 20% bonds for high risk tolerance individuals. But realistically, at this point, it's probably closer to 10% bonds, around 20% real estate, and 70% stocks. Or you could go a little bit heavier at 30% real estate, 10% bonds, and 60% stocks. However you want to do this, it's important that you use alternative investments, which would include things like cryptocurrencies. However, these are generally correlated with other commodities similar to gold. which is another way to diversify your portfolio further. Moving on to my investments, starting with worthy bonds. No real changes here. You can see I continue to withdraw this money and move it over into other assets. It's currently my understanding that they are still sold out of bonds and that they're working on a Worthy Community 2. I've seen stuff online that shows that Worthy Community 2 is up and running, but for some reason they're still saying they cannot award any further bonds. Not sure how this is working exactly right now. I have sent them a message, and I'll probably throw it down in the comments once I get a response from them. And you can see that shown here. Referral Rewards Program currently sold out of all the bonds they can currently award. I suppose this could mean they are reserving bonds to be sold, and they don't want to award them and give them away for free. But I can't find it anywhere on their platform that shows whether Worthy Community 2 is available, or even if they are sold out. It doesn't say one way or another. Moving on to Yotta Bank. I don't talk about this platform every single week, but they have added some new features, including buckets, which allows you to allocate your money towards specific goals. For example, if you're trying to save up for a down payment for a house, or potentially a down payment for a car, or any kind of major purchase, even a vacation really, you could use these buckets, and it allows you to track your progress more specifically. I don't know if I've mentioned this in the past, but they also started the Yotta debit card, where you can get all kinds of free gifts, like 10% back on tickets for all of the money that you spend. You never lose tickets when you spend any of this money. And you also get a chance to get free stuff, so a 1 in 500 chance that the item that you bought is free, which is actually pretty good odds. And then you get 1,000 bonus tickets for the first $2,000 that you spend. Moving on to my Yotta group, we are up to 5 members, which is pretty cool. So if you do have a Yotta account, definitely go join our group. This is a public invite code, the portfolio bulletin with no spaces. You should be able to search this and go ahead and add yourself. If you're struggling with this, you can definitely throw your information in the comment section below and I will add you to our group. Currently, we have 449 new tickets shared with the group, and I contribute all of my 122 tickets to this group as well. And you can see my returns in March were 1.87% APY, and I've currently earned over $17 in prizes, which is pretty cool, as well as $3 in savings rewards, which is just their normal interest rate. And then you can see their bucket system here, where you can add new buckets and manage them and move the money around towards your different goals. But overall, I'm happy with the way that they continue to improve on their platform, and definitely go check out this group and join the club. Moving on to GroundFloor, up to 112 notes invested with almost $3,500 overall. I have a little bit of cash on hand. I'm waiting for a deposit to get this up to $20, as you must invest in increments of $10 into these notes. And it's an odd amount because I got my second loan paid back. So currently my earnings are at $1.61, which is cool to see that the system is continuing to work. You can see my 2 notes paid back, $60 invested, with an expected rate of return of 10%, and I received 10.1%. Currently, I don't own any shares of GroundFloor, but I'm seriously considering buying some, as the real estate market has been very hot and GroundFloor seems to be continuously improving its platform, and it is working for me. They also added these different tabs, so you can see if you have any issues like notes being extended, defaults, or past due notes, as well as their diversification analysis, which is something I touched on in my overall overview for GroundFloor. And then you can see all of your different notes that you're invested in and when they are expected to be paid back. You can also look at just repayments, as well as your equity holdings if you do buy GroundFloor stock. Lastly, for GroundFloor, I do want to mention that I did move this platform over into my real estate holdings. Even though these are technically bond investments, these bonds do correlate directly to the real estate market and should not correlate with the overall stock market. Moving on to Fundrise, which is a major way that I invest in real estate. I continue to invest, and I did actually get my appreciation assessed for first quarter, which was another $100 in returns, along with the $127 that I received in dividends. Not huge returns, again, because this is a long-term growth portfolio, so I'm not going to see a ton of returns here in the beginning phases. But as my investments begin to mature over the next few years, I expect to see these returns go up. Moving on to the projects, you can see I have continuously been receiving new projects added to my portfolio. New projects. This project was successfully completed and paid back, averaging a 16.3% return for investors that were invested for the duration of the project. Another one successfully returned, again 16.3%. And then new projects continuously being added. And then the IPO, which I did invest in. If you have any questions on the IPO, I did a full video on that as well, which I will link above. Otherwise, looking at my goals here, I did up my contributions to $650 per month because I do want to increase my overall holdings in real estate. And as I mentioned, this is one of my primary methods of doing so. If you're interested in adding real estate to your portfolio, there will be a link in the description that will get your fees waived for the first 90 days. Moving on to my retirement account, it doesn't show any changes here, but it did actually change this contribution allocation. It's now going to be 60% the S&Ps and 40% the Russell 2000, as the S&Ps have recently broken out of their long-term price channel, which could represent somewhere around 30% upside over the next 2 years. The Russell has run up quite a bit, and I'm not sure that it's going to be sustainable, and we might see a little bit of a reversal in the Russell, whereas the technical picture for the S&P 500 is more bullish. I also stopped contributing to these bond funds, at least in the short term, which means all of this money will be going into stock for at least the next year. Looking at my retire account, you can see markets continue to go up, sitting at all-time highs, and over the past month, I've returned almost 6%, with almost $50 in earned dividends, which is quite a bit over the last month for me. Looking at my holdings here, you can see some pretty large returns, 8% in tech, 8% in consumer, 4% in real estate, and 7% in industrials. But overall, everything was positive. The main change here is that I increased this real estate holding up to 19%, which will make it the second largest, only behind tech here in this portfolio. And you can see I have a pending transfer here for $300, and this will buy all of my holdings here in real estate. You can look at exactly what I'm buying. American Tower Corp, Digital Realty Trust, Equity Lifestyle Partners, Innovative Industrial Properties, Stag, which is another REIT, Physicians Realty Trust, as well as WP Carey, which is another real estate trust. So overall, looking at real estate specifically, I have Realty Income, Welltower, LTC Properties, Federal Realty Income, Store Capital, Simon Property, and NRZ, along with all of these new ones that I added and will be buying this week. Moving on to my higher yield savings account, up just over 3% here, continuing to do well on the month, a little bit over $50 in dividends, which is good. And then everything was up except my bank balance sheet, which consists of entirely bonds, and it was only down a very small amount, only $2 in the past month. Everything else continues to go up, with Drogo leading the way at 6.66%. I have no plans to add money to this portfolio, and all of the dividends are going to be reinvested into the markets here with these dividend ETFs, as well as the Vanguard Value ETF, and even a little bit here in the Vanguard Dividend Appreciation Fund, which is by far the highest volatility index in this portfolio. Moving on to my Robinhood portfolio, you can see I'm not quite at all-time highs back from February, but I'm definitely moving in the right direction, almost back to that $12,000 mark. I do full portfolio overviews every weekend that I'm not doing my money moves videos, so definitely hit the bell so you don't miss out on those. Every week I also do videos on individual stocks, so check those out as well. But stocks to mention here, you can see NEO is down quite a bit towards its previous lows from around March 8th. And I'm also trying a very small position here in AT&T, and we'll see how those work out going forward. Moving on to my Tastyworks portfolio, you can see my Roth IRA is up quite a bit now, over $461 year to date. My individual account is still doing fairly well, not up quite as much as it was. I took a couple of short-term bets that didn't work out. I'm trying to learn a little bit more of short-term options trading, which is a series that I'm working on. You can definitely check out the first episode in that series, which I made this last weekend. So definitely check that out and let me know what you think. I do plan to continue developing that strategy. Another thing worth mentioning here is my taxable portfolio is actually negative delta right now, meaning I will make a little bit of money if the markets go down. And that's because some of these companies like Roku, Costco, and Square have all shot up pretty dramatically in the last week, and they look a little bit overextended, and I expect to see a little bit of a retrace in the upcoming week or two. And if you don't understand what any of that means, like I said, go check out my previous video on short-term options trading and technical analysis. Moving on to my bi-weekly tracker, you can see stocks and options continue to trend up in the right direction, basically moving at the same pace right now. Again, because I have a little bit of short delta in options, where I'm currently losing a little bit of money, but I expect those short-term trades to pay off here in the next 2 weeks, which should allow me to continue this growth, even if stocks decline a little bit. Looking at REITs, you can see a huge growth here because I moved those GroundFloor nodes over to REITs. I should call this probably real estate here, and I think I will, because this is not purely REITs anymore. I'm invested in Fundrise, which technically isn't a public REIT, as well as investments in GroundFloor. So this is now real estate holdings. So there was some growth here, but mostly this is just moving money over from bonds and into real estate, which is what you can see happened here with REITs going up and bonds going down exactly counter to each other. This was just a reclassification of this money. And then Lending Club continuing to trend down. Again, looks like it's accelerating a little bit, which is good, which means I can move this money over into different investments and potentially get higher returns. Cash continues to be stable, which means I'm investing or spending every dollar that I get. Net, I went up 2%, retaking the highs of February 13th in my overall net investments. So if you don't have any real estate holdings, definitely check out some public REITs, the ones that I mentioned either in my M1 portfolio or private REITs with Fundrise or even GroundFloor. Get some money diversified away from stocks and bonds and into some alternative investments, in my opinion, and that will benefit your portfolio over time. Let me know down in the comments section what you think of my thoughts on real estate. And if you like any of these platforms, check out the links in the description that will get you some free stuff if you sign up with them. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to today's jelly. For today's jelly, in this case, I chose Bo Burnham's overall YouTube channel. I like a lot of his really old stuff going back to 13 or 14 years ago, and I was rewatching some of this here recently, and it's just as good now as it was then. He did do some full shows, which are an hour long, and you can watch the whole thing on YouTube, but he is a perfect blend between humor and existentialism, and it's also a little bit of entertainment versus pure comedy. So definitely check that out if you like music that relates to comedy and life in general. If you got any value out of this video, definitely like and subscribe before you go, and have a great day.